Hello friends, welcome to the Warrior series of BFM. In Warrior series, as you know, we are covering the case studies plus MCQs. Case studies are related to your numericals also as well as your theory also. Same about MCQs, numericals and theory. You know the importance of numericals and case studies in BFM. Roughly around 40 marks case studies you get. Out of these 40 marks, roughly 25 marks you get numerical case studies. And remaining theory ones, and remaining all are these one-liners. You get numericals over there also, one-liners also, you get numericals in case studies also. So understand the importance of case studies in and one-liners in BFM. Watch it completely, share it with your friends, like the video, subscribe to the channel. Today is a big session, so let's start. In the treatment of second loss facility, which of the below statement is true? Now, second loss facility. What is second loss facility? Whenever you have a loss, means any bank, whenever you have a loss, certain situations might arise that you might face a loss. In that case, what is the capacity to absorb it? Everything depends on that. Without hampering your daily activities, that is also very important. So which of them is true? The deduction shall be made 40% from tier 1 and 60% from tier 2. The deduction shall be made 50% from tier 1, 50% from tier 2. The deduction shall be made 60% from tier 1 and 40% from tier 2. Similarly, last one, 70% from tier 1 and 30% from tier 2 deduction. So which one is true? See, this we have solved it in many numericals. So that's why you need to check this. Many numericals we have solved this. What do you do in this case? Tier 1, tier 2. Kindly note, it is always 50-50. 50% in tier 1, 50% from tier 2. Always the same rule is used. Okay? The primary responsibility of understanding the risk run by the bank and ensuring that the risks are appropriately managed should be clearly vested with the. So understanding the risk and appropriately managed. So it should be vested with whom? CEO, board of directors, auditors, shareholders. Actually managing the risk is everyone's responsibility, but prime responsibility, prime part over here is played by whom? Board of directors. They are the main party, they are the main concerned who have to follow the risk, understand the risk. Kindly note how it works. How does it work? Let me show you that. See this. Firstly, board of directors in any bank, at the top level is board of directors. Below the BOD, we have, what do we call it? In the comment section, everyone type it in the comment section. What do we call that committee? It is called as RMCB, Risk Management Committee to Board. RMCB, Risk Management Committee to Board. Module B, chapter number 1. Module B, chapter number 1. Framework. This is called as risk framework. Below this, which is the committee? Below this, there are 3 committees. Okay, ALCO, Asset Liability Committee, then CRMC, Credit Risk Management Committee, and ORMC, Operations Risk Management Committee. So these are the 3 committees below the board of directors. So this is the framework. Below this, there are support groups. Okay. So this is how the whole banking framework works in terms of risk management. This is how it works. So ultimately at the top, who's there? Board of directors. Okay, got it everyone? Move on. Next. RAROC is modified return on investment. That is ROI, modified ROI. Figure that takes elements of risk into account. So what is risk? RAROC, risk adjusted return on capital. Okay, risk adjusted. Somebody calls it return on investment also, I. Okay, somebody calls it E also, equity. Depends. Which of the following is a formula for calculating the RAROC? So now you want a formula for calculating the RAROC. Expected return upon economic capital, expected return upon VAR, value at risk, expected return upon total assets, returns minus cost of hedging upon capital. Which one? Think. Logically also you can think. Which one? Yeah? Which is the correct answer over here? Think. See this, RAROC, risk adjusted, risk adjustment part. So I'll give you an example. From there you will understand. Suppose let's say, I buy a stock, okay, shares. Suppose if I buy a share for let's say 100 rupees, 100. And then that share goes to let's say 150 rupees, 150. So what is my ROI? Return on capital. We will simply call it ROI, ROC. So that is 50 rupees. So here I am getting 50 rupees. So this is my ROC, return on capital. But what do I want? RAROC, risk adjusted. So what is risk adjustment now? See, I am afraid that this share, instead of going up, it might go down also. So if I want to prevent myself or protect myself against this risk of going down, what will I do? I'll buy a put option. I'll buy a option. And that option will be put. Whenever you are long on any commodity, any share, any commodity, you must buy a put option to hedge that. That is called as hedging. Hedging the risk. Now for the premium for this put, the premium for this put will be let's say 30 rupees. 30 rupees. Premium for this put is 30 rupees. So now this premium I have to give. Option is like the insurance. Car insurance, bike insurance. You give the insurance premium. If nothing happens, your premium is wasted. Same thing. So your option put, I am giving it 30 rupees. So now what is happening? My returns were 50 rupees, but I paid the premium of 30 rupees. So minus 30. So what is my RAROC then? My RAROC is 20. RAROC, if you say, it is 20. But what is my ROC? Understand the difference between ROC and RAROC. 50. ROC is 50. Return on capital is 50. I have invested 50. But if I adjust the risk, then it goes down to 20 because of this premium. Of course, this premium is not that huge. I have given it 30. It's never 30. That much big. For investment of 100, you can't have a premium of 30. It will be hardly 5 rupees. So this is just an example I gave. So what have we done over here? Returns, say this returns minus cost of hedging, say this 30 upon capital, whatever you have invested. So what will be my RAROC over here? 20 upon my capital. What was my capital? 100 rupees over here. In fact, not even 100. Okay, what was my investment? 130, 130, 20 upon 130. That is my RAROC into 100%. Okay, because my investment depends on both. So, this is the formula. Returns minus cost of hedging upon capital. Got it? For an assessment of working capital needs of a borrower who requires fund-based limits in excess of dash crores, the cash budget system instead of cash flow statement should be used. Now for this, first you need to understand what is cash budget and what is what are the methods basically of working capital. This is part of your ABM also. Basically we have three methods. One is cash flow, second is cash budget, and third is Tandon committee. Processing or ratio analysis you can call it. Okay, so these are the three methods we use. cash flow is used. Okay, I'll show you. Firstly, let me see the answer from your side. The ceiling advances borrower is this. One sec. Yeah, this one. Firstly, let's get the answer for this. What is the answer you are giving me? 5 crores, 50 crores, 10 crores, 20 crores. So above what limit should I use cash budget system? 10 crores. Okay, 10 crores is the answer. Now what is cash budget? Say this. Cash flow and cash budget. There are two methods. And third one is also the processing. That will keep it separate, because that is simply processing of loans, ratio analysis. Today in various industries, all the three methods are used. Big industries use cash budget. Small industries use cash flow. Small means Theliawala and all these. Small shopkeeper, cash flow. Big companies, Amazon, cash budget. Tata, cash budget. Mid-sized companies, ratio analysis. So here, in cash flow and cash budget, what is the difference? The difference over here is, see, in cash flow system, what happens? We use only the present cash. Whatever comes in, cash goes out. Cash flow statement, same. We only check the present cash. Both. Means if I use cash flow, this present cash is used in both. Cash flow also, cash budget also. But what is the difference then? In cash budget, I use the future cash also. Future expected cash. So that's all based on the project report. That is normally not used for the small shopkeepers or small firms. We don't use this projection. We use only the present cash. Cash flow. Cash budget, big companies, we use the projected cash also. Big companies. So this is the difference between cash flow and cash budget system. Both are similar. Cash flow means present, cash budget means present plus future. Over. Okay? Next. Read this. The ceiling for the banks for providing advances loans to the borrower is dash percentage of the capital funds in case of single borrower and dash in case of group borrowers. So now, what is the answer for this? Think. So the answer for this is, it is, say this. For single borrower versus the group borrower. Now, what do you mean by difference? What is the difference between the two? Suppose, let's say, tomorrow if single company, let's say Reliance Oil, which one? Let's call any company of Reliance. Let's call it Reliance Jio. Okay, so Jio comes to you for loan. So that is the individual company. Or now Reliance Group comes to you. Reliance Group as such. Okay. Now understand, the whole group has come to you. All the companies together. So then these two rules apply. So the rules are like this: 15% for single and 40% for group. Okay, 15% for single and 40% for group, and you can extend with 5% extra for infra companies, infrastructure. Okay, so that is allowed. If the group is working in infrastructure or any infrastructure project. Which of the components of bank's balance sheet is not included in the liabilities? So which component is not included? Kindly note. In the liabilities, see, important question is liabilities. What are the liabilities? Liabilities means which you have to give, where you have to give the interest. Your deposits are liabilities, plus your borrowings from other banks, inter-office adjustments, provision for income tax, overdraft, and capital. So which of them is not included in the liabilities part? Yes. components which are not included in the liabilities part, which are not the liabilities. Yes, think which of them is not the liability for the company. Liabilities part. So it is, see, first let's cover this. Provision for income tax means I have to pay. So it's a liability. I have to pay for that. So this will be the provision. It will be there. Overdraft. What is an OD? Overdraft. Now think. Now this will give you the hint. Overdraft for the customers. See, overdraft means overdraft for the customers. So what is that? Is it a liability or an asset? It's an asset. It's not a part of liability. Overdraft for the customers. It's an asset. So that's why this won't be the part of your liabilities. Remaining all will be. Capital is also liability. Capital, why capital is a liability? Capital is a liability of the owner, means of the business towards the owner. So business has to give the money to the owner. Okay, that is liability. So the answer is OD, overdraft. Because this is the part of your asset, not the liability. To put in place proper LRM, loan review mechanism, for large value accounts, which of the following options must be considered? LRM, loan review mechanism. Now what is LRM? LRM is deeply covered in ABM. See, kindly note, ABM and BFM, they are related to each other. Many parts are related. Module C of ABM is mainly related to BFM. Okay. LRM is basically the audit of the process. See, what is LRM? LRM is actually the process audit, or you call it credit audit also. It's an audit of the process. Okay. So which of the methods are used? Which of the following options must be used for LRM? Evaluating the effectiveness of the loan administration, maintaining the integrity of credit grading process, assessing the loan loss provision, and all of the above. So what are you doing actually? You are doing LRM means you are checking the process of the bank. So while checking the process of the bank, you have to check everything. What do you say? In the comment section, let me see. Is it A, B, C or D? Comments. Let me see in the comment section. Yeah? You have to do it all of the above. All of the above is very important. Again, all of the above. Evaluating the effectiveness of loan. So you have to evaluate the effectiveness of loan administration, whether you are monitoring. What is loan administration? Whether you are monitoring the loans correctly, whether the stock statements are coming properly, whether the stock statements are correct. That is all loan administration. Whether the EMIs are coming correctly. Maintaining the integrity of credit grading process, that is also very important. Credit grading means proper rating parameters. If your rating parameters are not correct, then your ratings are of zero value. Okay? Assessing the loan loss provision, this can be assessed using the tier 1, tier 2 capital. Okay? So the answer is all of the above. Which among the following is not an element of tier 1 capital? Not an element of tier 1 capital. Not, kindly note. Revaluation reserves, paid up capital, ordinary shares, statutory reserves and other disclosed free reserves, perpetual non-cumulative preference shares. You want not, okay? Kindly note. Innovative perpetual debt instruments, all of the above are the part of tier 1. So which of them are not the part of tier 1? Revaluation, paid up, PNCP, IPDI. For this you need to understand first the tier 1 capital elements. Okay? What are the elements? Let me see if I have given no. What are the elements of tier 1? Kindly note, tier 1 has two parts. One is, okay, I'll give you orally only. I've covered this many times. Tier 1 has two parts. One is CET1, Common Equity Tier 1. CET1, common equity tier 1, and second one is 81, additional tier 1. Additional tier 1, CET1 and 81. Okay? What is CET1? CET1 means pure capital of yours, which is yours only. What are the parts of that? All these. See, out of these four, one, I'll just write it over here only. Revaluation reserves, that's the part of CET1. I'll write C over here. It is always taken at 55% discount. So this is the part of CET1. Paid up capital, ordinary shares. So that is the part of your CET1, C. See, ultimately, this CET1 is also a part of tier 1 only. Both of them are the part of tier 1. Okay? So kindly don't confuse this. CET1 and 81 are the part of tier 1 only. Then C over here. Then PNCP. Now this is the part of 81. A. This 81. PNCPs. Then innovative perpetual debt instruments, IPDI. That is again a part of 81. But ultimately, if you see, all of these are the part of tier 1 only. Isn't it? So all of these are the part of tier 1. Isn't it? Got it, everyone? Clear the concept? See, these things are very important to understand. You must first get it very clear. Okay? That what is it? Got it, everyone? Chalo now. Now, before going, everyone kindly note, join the crash course of ours. The new batches have just started. Okay? The new batches are just, in fact, some ABM and BFM I am starting today. So, without fail, you must join this. See, this is Increment Mahapack. That also, firstly, I will always suggest you to join the Increment Mahapack for CAIIB, because here you are getting 15 plus batches per subject. 15 plus. Plus you are getting formula bank. Plus you are getting question bank. Okay, for all the subjects. Very informative, very useful. Plus, double validity offer is going on. You buy for 6 months, you get it for 12 months. Plus discount now. Look at the discount. Put the code Y432. Never forget this. Y432. Okay? Enter. 80% discount. Plus 1% extra through the app. So 81%. Plus double validity. Plus 15 plus batches. Join this. You need not join any other batch then. And validity is also huge. Also, the new crash courses have just started. Okay, join these crash courses. See this crash course of CAIIB. Join this ASAP. Ebooks, mock tests, online live classes. Mock tests are chapter wise, full length, both. Ebooks, chapter wise. Recorded sessions, live sessions, all. What all do you want? Plus discount offer. Discount offer of the same, 81%. Don't miss this discount. Okay? But code is very important. Y432. Remember this, 81% discount, 80 plus 1, 1% through the app. So join anything, join the crash course, join this Mahapack, Increment Mahapack, join anything. I would suggest you to join the Increment Mahapack. Bye. Never forget the code.